Hello friends, last week in my video, we discussed specifically about whether the correction in the markets was over. I told you a certain pre-required conditions needed to be fulfilled by the bulls before we could say that the correction is done and over with. Unfortunately, those conditions were not met. Volatility continued to remain higher, bid and offer spreads were wider, and there were definitive signs that bulls, at least the retail traders, appeared to be a little nervous. Now, we are going to take a look at the statistical data, which is what you know me for. And I'm going to basically break it down for you and we'll come to the conclusion as to what to expect in the week ahead. Coming up on your screen is the weekly market roundup window, which basically tells you that, as again, like last week, it was the bank Nifty that led the market from the front, with the Nifty following up in the rear. The US dollar index gained 98 basis points, and that basically kept emerging markets, including India, under check. Gold prices went up in spite of the dollar, but silver succumbed to profit taking. Oil and gas rose very marginally. Oil more because it had expiry of the March series, and there was some short covering, and gas basically is witnessing a little bit of sporadic buying. The USD INR hit a record high, which means the rupee has given a new record low against the dollar last week. The Indian 10-year benchmark bond yield went up by 1 basis point at 7.07%. The NSE gained 1% in market capitalization. Market-wide position limits, or MWPL, went down by 98 basis points. Now, where the US indices are concerned, they rose, all three of them. It was the technology-heavy NASDAQ that led the rally, and that raises the possibility of Indian IT stocks being firm in the coming week. Friends, the market roundup done. I now come to our in-house indicators. I start with the MWPL, or market-wide position limits. This is the first sign that you will see that bulls are definitely not buying as much as they were in the previous months. Of course, the shorter week ahead, because Monday is a holiday on account of Holi and Friday is a holiday on account of Good Friday. The shorter week ahead and the expiry itself of the March series, the financial year end, balancing of books of accounts, income tax payments, all of them have come together. But the fact remains that for whatever reason, the MWPL has peaked out at 38.36, which is the lowest in the pre-expiry week. What I would want to see is where it plunges to on Thursday, which is the expiry of March derivative cycle. If it goes below 29.15, which is the February post-expiry low, I think that would tell you that traders are really going light. Now, friends, I come to the index and stock futures turnover. Remember, these are three concurrent series, so it's March, April, May. And what you saw was stock futures turnover went up, whereas index futures turnover came down. Now, part of this increase in turnover is also due to expiry, when traders are exiting out of their March futures exposure and getting into April. So there's a double turnover recorded there. The real trend determination will come next week. Friends, I now come to the NSE advanced decline ratio, which spiked up to 1.57, in spite of the fact that the Nifty logged smaller gains. Now, why has this 1.57 advanced decline ratio come about? Hey, it's purely because of Thursday. We saw a huge advanced decline ratio recorded, and obviously Thursday's advanced decline ratio of 3 plus cannot be sustainable over a period of time. It pulled up the overall weekly advanced decline average as well. I don't expect this kind of buying momentum to sustain, especially in the expiry week when short covering is the best hope of a buyer. Friends, I now come to the Nifty and Bank Nifty prompt month futures basis. Basis is nothing but the premium or discount prevalent in the future compared to spot. The closer we get to expiry, the smaller is the basis, and sure enough, what you saw was Nifty and Bank Nifty saw a compression in the basis, which is along expected lines. As long as the basis is not negative, which means the futures are still trading at a premium to spot, I think there is no sign of panic or short selling in large quantities in the market. Friends, I now come to our in-house indicator, the impetus, which you've trusted for more than 3.5 years now. What you saw was the Nifty rose last week with a mildly higher reading in the impetus, which means the weekly momentum was slightly higher. The Bank Nifty, on the other hand, in spite of the fact that it rose more in percentage terms compared to the Nifty 50, saw lower impetus. That tells you that it was mainly short covering rather than a proactive fresh buying that has pushed the Bank Nifty higher. Ideally speaking, I want the price and the impetus to go up together. That's not happened, which is another sign of bulls being marginally nervous. Friends, I now come to our in-house indicator, the lift, weight, thrust, drag indicator. And what you are seeing is, in spite of the fact that the Nifty logged smaller gains last week, the LWTD has gone up from 0.17 in the prior week to 0.26 last week. Now, this tells me that there is a possibility of week on week, relatively speaking, better buying. Not surprising, because in an expiry week, short covering is invariably higher than long squaring up. It is bigger amounts of longs that are carried forward to the next position. Shorts do tend to get squared up. So you could basically see proactive short covering. Friends, the in-house indicators done. I now come to the bond market, which is very close to my heart, and we've been leading the research space with our coverage of bonds before equity for many, many years. Now, do note how Indian benchmark bond yields have gone up by 1 basis point on a week-on-week basis. This is one reason why I had recommended that my online family exit the 4 gilt funds that I had recommended to you on 14th of December. Last week, we managed to get out at a handsome profit. Now, the point is that all the kind of expectation and market consensus on rate cuts are now on the back foot, which means the Fed is saying, hey, inflation has not come down as much as we think it should have, and therefore we might cut rates fewer number of times, and the rate cuts might also be a lot more tepid as compared to what was expected by the market. Now, this can lead to volatility in high-risk assets like equities, currencies, and commodities. Bonds, of course, will be the direct impacted underlying asset, and therefore they will also be a little more volatile. It's time to be careful out there. Is the last recourse for a fixed income investor with a high requirement of safety, is the last recourse over? No, no, no. We are always having alternate ideas. We are always keeping plan B, C, and D in our drawer, and it's going to be released to you on our free Telegram channel at the appropriate time. My contact coordinates come at the fag end of this video. Friends, the bond market's done. I now come to the Bank Nifty, which led the way forward. It logged gains of 0.58% and rose on 2 out of 5 trading sessions, as you can see on the daily chart on your screen. Wednesday was a very interesting day. We saw a huge intraday range, and there was a long leg doji, which is seen on your chart on Wednesday. The price has just managed to close above its month-long moving average, which itself is looking sideways at this point in time. What we do want is the Bank Nifty to stay above the 46,370 level sustainably, failing which bears might just get a little more aggressive. Coming now to the weekly chart, what we are seeing is the weekly range had breached the 25-week exponential moving average downwards, and this average is a 6-month long holding on cost of an average bull. So for a while, the medium-term investors may have been nervous, but the closing was way above the intra-week low. So at this point in time, the medium-term outlook does seem to be okay, but only for now. we are still on shaky grounds. We are walking on thin ice where the Bank Nifty is concerned. Do remember that the bullish candle size is far smaller compared to the prior week's power candle, which was bearish. We do still need to watch the 46,370 level, like mentioned here in the chart, with a red trend line. Friends, in the week before last, this index was number 5 on our most volatile counters list as per statistical beta rankings we maintain in-house. It stayed there, and that means there was no increased volatility, relatively speaking, in the last week compared to the prior week. Last week, I advocated an estimated range between 48,000 on the upside and 45,175 on the downside, which held perfectly well. In the coming week, I estimate a range between 48,275 on the upside and 45,450 on the downside. Now, the lower impetus reading that I had told you in our in-house indicators segment tells me that this was more of short covering in the Bank Nifty as compared to long buying. And this could have been partly explained by the expiry. Friends, also check out our free daily, weekly, and monthly pivots on our free Telegram channel, which will help you basically trade a lot more accurately, and do connect with me for many, many more trading ideas on our channel. Friends, the Bank Nifty done, I now come to the Nifty 50, and as you can see on the daily chart on your screen, it has gained relatively smaller amounts as compared to the Bank Nifty, because it rose 0.33%. However, it rose on 3 out of 5 trading sessions, and like the Bank Nifty before it, Wednesday's candle is a long leg doji where the bulls and bears kind of fought it out, but at the end of the day, it was a draw. The long intraday low of this session is particularly important to note, because this is where you might see some amount of support coming in, and that is 21,710. As long as the bulls can defend this low, I think there is a chance that they might just take the markets higher. The price has closed at its month-long moving average, but definitely below the 261% Fibonacci extension level at 22,200. Only after 22,200 is overcome forcefully with higher volumes and open interest expansion, would I say that bulls are back. Now let's take a look at the weekly chart. It shows a bullish hammer, which means the intra-week low at 21,710 is where there might be resistance to further declines. And if bulls defend this level, chances are the Nifty could basically trend above that weekly low, last week's weekly low. The price is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. That tells you that the medium-term outlook is positive for now. Relatively speaking, between the Nifty and the Bank Nifty, I would say that the Nifty's chart appears more robust. But as the inset box at the lower end of your screen tells you, that over a 4-week period, the banking stocks, which is the Bank Nifty, has, relatively speaking, outperformed the returns provided by the Nifty 50. It has been an underperformer over a 12 and 14 week period, but the short end is seeing bear covering. Now, unless and until the Bank Nifty sustains this outperformance compared to the Nifty 50, I would say that this market might just suffer some more profit taking at higher levels. Why am I saying that? Because banking and financial constitutes a 33% weightage in the Nifty itself. So unless the banking and financial sector moves upwards, it will be difficult for the Nifty to sustain an up move in the coming week. Friends, in the week before last, this index was at number 12 on our in-house statistical rankings, beta rankings that we maintain in-house. It rose by 3 notches to number 9. Not good. If volatility goes up, that's more challenging for you. Last week, I advocated an estimated range between 22,500 on the upside and 21,525 on the downside, which held perfectly well. In the coming week, I estimate a range between 22,600 on the upside and 21,600 on the downside. I would suggest we trade light in the coming week because it is shorter. Monday and Friday are holidays. And in addition to all the above inputs, do watch free daily, weekly, and monthly pivots on our Telegram channel. Friends, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite by the turnover constituted in the four segments of the F&O space. The weekly chart on your screen tells you that index futures contributed 0.02% lower last week, which is indicated as a blue line. And stock futures constituted 0.05% higher contribution turnover last week. It is indicated as a red line. Now, since futures demand a higher amount of span margin, they are more volatile, mark-to-market payouts are required. The fact that there was increased turnover in the futures space tells you that risk appetite was higher. But it's not as simple as that. Do remember, in expiry, there is squaring up. That means winding up of trades in the March series and reinitiating the same trade in April. So double turnover is recorded. So next week, we'll need to watch the retail risk appetite data a lot more carefully. Where index options are concerned, we saw 0.10% decline in turnover contributed is indicated as a green line. The stock options contributed 0.07% more over the prior week. It's indicated as a purple line. Here again, my logic for expiry related short covering and rollover contributing to higher turnover kicks into play here. Friends, now I'll discuss my trading strategy for the week ahead. Do remember, it's a short week and I continue to focus on public sector units, PSUs and PSBs, public sector banks. I've recorded a video last year as to why I prefer PSU banks. Do watch that video. The hyperlink is in the description and in the pinned comment below. I would also look at oil marketing companies, OMCs, and PSUs, PSB, especially OMCs, are displaying above average statistical beta or intraday pure price volatility. Now, if you're savvy, if you know how to manage risks, if you know how to find your way in and out of trades in the market, you may want to focus on these stocks. But hey, volatility, or very high volatility rather, is assured. So let's be careful out there. Metal prices on international commodity prices in commodity exchanges seem to be under pressure. So shares of metal companies, especially mining and exploration companies, may be weaker unless expiry related short covering cushions the declines, which would in any case be temporary in nature. I remain circumspect or doubtful on the bullish views in the public domain about oil and gas prices. I'm cautious, even bearish. So I continue to seek theta decay opportunities in oil and gas in the option space. And since natural gas contracts of March are expiring on Monday, I do expect a turnover to start perking up in the June series and the June futures series rather, which is what, provided of course I get a good calendar premium on June, I might just think of initiating some positions on the short side. Precious metals, bullion, may see some profit taking on a strong US dollar index, which I had mentioned even last week. But the overall trend remains up, and lower levels are likely to see buying support coming from long-term investors. Being a short week, I do remind you that the bid and offer spreads will be wider. Ingress and egress, that is order entry and order exit, will be far from smooth. You might have to wait a long time for your trade to kind of get initiated or triggered. And even if you do, your execution costs, thanks to wider spreads, will mean that you're going to take home smaller return on investment in percentage terms. I'm not saying the amount of the absolute number of rupees you're going to take is smaller, but ROI, return on investment, might be compressed because it's one of those weeks where uncertainty may be fairly high. It pays to cut down your traded exposure size. Before I bid goodbye to you in this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts of videos being put about here. In the comment segment, do let me know how my work is helping you become a better trader. And hey, share my video with your social media groups, your friends and family, so I can get across to savvy traders like yourselves and spread the cult of knowledge-based investments and trading. I thank you for your patience for being with me in this long video. Till we meet again in my next video, this is Vijay Bhambwani signing off. Do have a very, very happy, holy and a profitable week ahead. Take care. Bye-bye.